Hey everybody, welcome. Today we're going to draw percentile bands around an exponential regression of the gold price. Okay, so a few things have happened on my end since my last video. We have moved. You may notice the background in my office is different. Probably will change a little bit in the coming days and weeks as I get more settled in here, but I wanted to get right to it. Continue with our Trendline regression series. This one's going to be much quicker, much easier than the last intro videos. We did a lot of work in the last 2 weeks. We did a lot of work. We covered linear trend lines, logarithmic trend lines, exponential trend lines, and power trend lines for both the gold and Bitcoin prices over the last 50 years. We also looked at the US money supply, just the basic physical currency supply. Just to give you an idea, these are the types of things we'll continue to look at, track the growth, track the rate of change, try to see if we can understand what the trends mean in the market. And today will be, I think, much easier. Let's not go through too much of the basics anymore. Let's just go ahead and let's review the best trend line that we established with the gold price, which is the exponential regression trend line over the last 50 plus years of gold price history since the Nixon shock. So here we go. We have the chart again. You see the Nixon shock here, the end of Bretton Woods, when it was creeping up from $35 an ounce. The market could no longer take it. It broke up. And then the Bretton Woods agreement ended, the Vietnam War ended, Americans were allowed to hold gold, the Smithsonian agreement ended, where gold was statutorily $42 an ounce, still is $42 an ounce today on the United States' books, but nowhere else in the world. Gold floats freely in the market, and it has been since 1971. And I added one more little tidbit here for you on the timeline. This one in September of 1999, Brown's Bottom. Brown's Bottom, what was that? Well, that was when former Prime Minister Gordon Brown of the United Kingdom, and at that time, former Chancellor of the Exchequer, which is basically the Minister of Finance or the Secretary of the Treasury, depending on which nation you're talking about. He was the Chancellor of the Exchequer in the UK at the time, and he decided to sell half of the UK's gold at this time. And as we talked about in prior videos, we were in a deep bear market since the Paul Volcker pricked the gold bubble in the early 1980s. The Fed funds rate peaked at 22%. And then the gold price went into a 20-year bear market. And Mr. Gordon Brown, at the time, Chancellor of the Exchequer for the United Kingdom, thought that that would be a great time to sell gold. And he sold half of the United Kingdom's gold at this time. Interesting time to sell in hindsight. In fact, the worst time to sell. I believe the agreement was concluded in September 1999. That's when I had this, and he sold it throughout the next few years, 99, 2000, 2001. I think they stopped selling in 2002 when the price started to creep back around. But yeah, half of the United Kingdom's gold has been sold from this point. And then, of course, we had the global financial crisis. Gold kept creeping up, and we had sort of two local highs, two all-time highs here. Once in 2011, where it was almost $2,000 an ounce, and then in COVID 2020, it was hitting $2,000 an ounce. And as of December 31st, 2022, again, we're still looking at gold here on a monthly frequency, $1,800 an ounce. So I'm going to put the exponential regression trend line back on right now. And there it is. We talked about this. If you want to learn more, check out prior videos. But this is the best fitting trend line for gold. It's the best fitting. The R-squared is 75%. Again, check prior videos if you want to learn more about how R-squared can be interpreted. The higher, the better. And this is the best fitting trend line for gold and the gold price, supply and demand over the last 50 plus years. And if we projected this out to December 31st, 2030, we would get a $2,400 per ounce gold price. So what I want to do now is once you have the trend line drawn, and this is the best trend line we have established that we can draw with gold, I want to start adding some bands around the trend line to see where we are today versus where we've been in the past, because this can help us a little bit more understand where the long-term trend has been and perhaps where it's going. So you may remember in your statistics courses, we have this term standard deviation, 1 sigma, 2 sigma, 3 sigma moves, basically. And what that means, very simply, a standard deviation is a band that can be drawn around the mean. And if you are, say, 1 standard deviation from the mean, that means that the price, or whatever you're measuring, can be up or down, and will be up or down, based on past performance, 2/3 of the time. 2/3 of the time, they will be inside of 1 standard deviation from the mean. And if you go 2 standard deviations from the mean, that's 95% of the time. The data will fall between 2 standard deviations, up or down around the mean. And then we have even 3 standard deviations from the mean, which is typically 99% of the time. 99% of the time, the data will fall up or down around the mean, and that is a 3 standard deviation move. So if at any time that data is outside of 3 standard deviations, it's a pretty rare occurrence. So that's typically as far as you go in basic statistics 101, 1, 2, 3 standard deviations from the mean. Now, an important thing to note about standard deviation is, without going into the details about how that is all calculated, that assumes the data works on a bell curve. All right, it assumes a normal distribution, it's called, of data. But we actually don't need to do that in finance. We can get a much more precise distribution of the data simply by using percentiles. So I will explain a little bit more as we go further, but all the data is right here. We can easily calculate percentiles. For example, where would we be in 1980 when we were going to $850 an ounce for a couple seconds on the COMEX and the world markets versus where we were here at Brown's bottom at the end of the millennium, 1999, 2000, a gold price was $250, $300 per ounce when Gordon Brown was unloading half of Great Britain's gold onto the marketplace. Where was the price of gold then in relation to the all-time trend? Well, for that, we can look at percentiles, and it's a beautiful way, very easy way to understand the trend. So I'm going to draw 2 percentile bands now, and we can still refer to these in the context of standard deviation because I'm using the same percentages that I just described. So let's go 1 sigma down and 1 sigma up. Now we have inside of this blue band, anytime the price is inside of this blue band on the chart, that means that the gold price was within 1 standard deviation, or as I'm using percentiles, I'm finding the exact percentage of the time. I think I'm using 67%, basically 2/3 of the time. 2/3 of the time, the price is inside of these blue bands. And so, for example, if we take any point here, let's go just after the financial crisis, gold did fall briefly and then started to rise again. Let's look at November 30th, 2009, month end November 2009. The price was $1,175 per troy ounce. The regression at that time was $860. That was the trend line, so we were above trend. But how far above trend? Well, we were getting close to a 1 sigma move, where we would be outside 2/3 of the time, but we weren't yet. We weren't. We were at, for example, here November 30th, 2009, 1 sigma up would be $1,254 per ounce. We didn't quite make it there. We were at $1,175 per ounce. So we're still inside these blue bands, which means we're still within a 1 sigma move from the trend line. And again, important to keep in mind, we're talking about trend lines here. We're talking about the exponential regression. We're not talking about the mean. We're not assuming the data works in a bell curve. We can very easily find this stuff simply by looking at all the prices, all the price activity in the past, running percentiles over all of that data, and just seeing where we fall. And now let's look back at our example, our Brown's bottom here in September 1999. Good old Gordon Brown decided to sell half of the United Kingdom's gold. What was the price at that point? $299 per ounce, September 30th, 1999. If you just look at the chart, you can see that was a pretty low point, right? But where was it exactly? Well, the price, actually, let me take off the one standard deviation up so we can just see very clearly what I'm talking about here. Brown's bottom, September 30th, 1999, $299 gold price, 1 sigma down, $326 per ounce. So the price at this time was below 1 sigma down. So he sold it at a kind of rare event, not completely, rare, but pretty rare. The air down here was pretty rare. And it's not a good type of rare for the United Kingdom. It would be a good rare if it was above these dotted lines, way above, but it was below. So it was a rare low price, actually, considering the exponential trend line of gold. And that price was roughly $300 an ounce. So he was just outside of a 1 sigma move from the regression, from the trend line. And yes, if I had run the trend line just at this time, you would have had a different conclusion. Okay, we can maybe do that in future videos. The black trend line, remember, is the all-time prices since gold has been floating, as we've talked about, since 1971. So this trend line definitely takes all those coefficients we talked about in earlier videos. They're all calculated from the all-time data. So certainly in 1999, Brown didn't have the knowledge that we have today. But it's quite interesting to see how these technocrats work in hindsight, because he was definitely wrong. He was definitely at a price that I imagine most of the people of the United Kingdom would not want to sell their gold at. And it was, in hindsight, a fairly rare price for gold. Rarely low. $300 per ounce. That's below a 1 sigma move. So two-thirds of the time, the price is above this blue line. And in fact, it's even more than that, because I have the 2 standard deviation. Let me put the 1 sigma up just to make sure it's clear what I just said there. Two-thirds of the time, the price is between these bands, right? So he was outside of that. So he's outside of a 2/3 move, a 2/3 percentile band for the gold price. That's when he sold. But now we can even go further out. Remember, I talked about 1 standard deviation away. Now we can go 2 standard deviations away. And that's when the data, not just 2/3 of the time will fall within these bands, but 95% of the time. That is a 2 standard deviation move from the trend line. So let's draw those bands right now. Lower one, upper one. Let's take away our 1 standard deviation moves. And now we can say, looking at these bands in red, that anytime the price is outside of this red dotted line, it is a 2 standard deviation move from trend, and it is rarer than 95% of months. 95% of the time, the price will fall within these red dotted bands. So if we go back to Brown's bottom, was he in a 2 sigma? Let's take away 2 sigma up. Let's just look at the downside, the rare air on the downside. September 1999, he was close to a 2 sigma down move, presuming that he sold somewhere around the market price, $300 per ounce. But he was not quite at a 2 sigma down move, which would have been about $240 per ounce. So he was between 1 and 2 sigma away from the trend on the downside. Not a good scorecard looking back at all. Certainly you wanted to be accumulating ounces during this time. You did not want to be selling. But that's what the former Chancellor of the Exchequer, Gordon Brown, did for half of the people's gold of the United Kingdom at this time. Brown's bottom. So let's go ahead and put all of our trend lines back. And this is all these beautiful bands that we can draw to really understand where the price has been, where the price might go. We can project it out into the future as well. But remember now, this is an exponential regression. And as we've established, gold, as many markets do, does move on an exponential curve, typically. And so how can we verify that this is indeed an exponential curve? We put it in log scale. So let's go log left. There we go. Log scale, everything turns to a straight line. It doesn't matter your base on the left, if it's base 2 or base 10 or base 100. Exponential regressions will always turn into a straight line on log scale. So if we look at the tooltip again, it is blocking a little bit here because I have so many data points. Let's take them off. Let's just leave the 2 sigma moves. So again, 2 sigma up or down, that tells us that 95% of the time we can be sure that the price has fallen within these red bands. 95% of the time, 2 sigma up or down move. And that's the trend line. So with 50 years of data for gold, we can kind of get a sense of supply and demand, because remember, price is where supply and demand meet. More ounces are coming out of the ground every year, and we'll talk about that as well. Gold's ounces come out of the ground roughly at 1.8% per year. They've done that for the last 200 and some years. And it's just interesting that, you know, we've had a lot of volatility. We've had a lot of things happen, a lot of firsts in the last 50 years with gold, but it still trends up. It trends up on an exponential trend line. And if you just look at this 2 sigma down and 2 sigma up line, you can be fairly confident that, okay, above, let's look at right here from the, let's actually go from the financial crisis, zoom it in. When we got very close to $2,000 an ounce in 2011, and then we hit it basically in, remember this is month end, in 2020, we actually didn't quite get to 2 sigma moves even. Those seemed like extreme moves for gold at the time. And if you follow the gold market like I do, you know, our friend Peter Schiff, who hates Bitcoin, loves gold, they were just shouting from the rooftops that it's time to buy. But look what happened. I mean, that wasn't even a 2 sigma move for gold. I'm not saying that 2 sigma moves won't happen in the future. I'm not saying that fiat currencies won't hyperinflate, and it'd be very good to hold precious metals and only precious metals, not other things like digital assets. I'm not saying any of those things. I'm just saying in 2011 and 2020, when the biggest gold bugs around were shouting from the rooftops, that wasn't even a 2 sigma move from the mean. Did I say 2 sigma from the mean? I meant 2 sigma from the trend line, from the regression. Important distinction. Again, this is not a standard deviation. It's a very similar analysis to standard deviation, but we're going around the regression. We're not going around the mean. The mean is typically what standard deviation looks at, and the mean, the standard deviation around the mean assumes a normal distribution or a bell curve. But we don't need to do that in finance. We have all the data. We can run percentiles. We don't need to take samples or a smaller population size to just assume something. We have the data. So we can see that it's not a bell curve, even though it actually, let's address this right now. Even though it looks like if you look at the bottom band here, 2 sigma down, and the top band, 2 sigma up, it looks like they're on log scale. They're pretty close to each other. Let's actually do the math. So let's go back to one of the highs here, July 2020. The price was almost $2,000 an ounce. The trend line was $1,450, $1,445 per ounce. Now, let's count how much down in dollar terms it takes to get to the minus sign here from the trend. Okay, so $1,450 $445, down 2 sigma down, $667 per ounce. So roughly $800, an $800 swing to go 2 sigma down. And to go 2 sigma up, how much is it? Well, 2 sigma up is $3,285. Remember, this is log scale. $3,285 minus $1,439, the trend line. All right, so how many dollars does it take to go 2 sigma up? It's almost $2,000, $1,800 to go from the trend line 2 sigma up. So you can see that $800 down or $1,800 up, that's not a bell curve, right? And that's just, and we don't need that for this stuff. We don't need that for finance. We can very, very easily calculate the actual percentiles and still use the lingo that standard deviation uses, 1 sigma, 2 sigma, get the percentiles to be a relatable number. Again, outside of 1 standard deviation, that's a 66% move, where basically 2/3 of the time you're going to be within 1 standard deviation. Outside of 2 standard deviations, outside of 2 sigma, that's a 95% move. So 95% of the time, the data will be inside these red bands. All right. So again, back to what I just talked about. If you go here at this time, the peak in 2011, where we're getting close to $2,000 an ounce, gold bugs screaming from the rooftops, or here in 2020, gold bugs screaming from the rooftops, it wasn't even close to a 2 sigma move to the upside. It wasn't even close. So that's a little bit on standard deviation and drawing these percentile bands. Let's go ahead and put 1 down and 1 up again in. We can see them all just to conclude. And if we go all the way out to December 31st, 2030, again, our regression trend line is $2,400 per troy ounce. That's the middle black trend line. Exponential regression, straight line on a log scale. So let's just summarize this really quick. If we wanted to have, or we wanted to see what it would take for gold to shoot like a rocket, not even by tomorrow, but by the end of the decade, by December 31st, 2030, December 31st, 2030, to make a 2 sigma move up, it would need to be $5,500 per ounce, $5,474 per ounce. That would be a 2 sigma move up, a very rare move up. Could it happen? Maybe. Gold has never even really been above $2,000 per ounce, but it needs to hit $5,474 to make a 2 sigma move up by 2030. And to make a 2 sigma move down from the trend line, it would need to go. It would need to fall to $1,100 per ounce. $1,100 per ounce, and then of course the bands in between a little bit more gradual. 1 sigma up, $3,500 per ounce. 1 sigma down, $1,500 per ounce. So the overall delta there is about $4,000 between the red bands. So that's might seem like a lot until we look at the Bitcoin chart. The overall delta between 2 sigma up and 2 sigma down moves. But yeah, I would just keep that in mind. Again, not financial advice. Past performance does not equal future results. I enjoy looking at the gold price. I think it has interesting things to say about fiat, inflationary policy, all the rest, which we'll talk about. But it hasn't made extreme moves, 2 standard deviations outside of trend. Looking back at all-time trend, really excepting for the 1980 boom, which again was about 2 seconds when it was at $850 per ounce, 2 seconds in January of 1980. And then just when it was coming out of Bretton Woods, it was below a 1 sigma move when it was $35 an ounce, $42 an ounce. When most economists, by the way, thought it would go to 0. Of course, it didn't do that. It did rise, and people saw a need for gold, except for Gordon Brown in 1999. But most people saw a need for gold as an inflation hedge, and it has stayed within these bands for the last 50 years. So there you have it. Last thing I want to say before closing this video, a lot of people in the gold markets, they talk about gold price manipulation, gold price suppression, particularly with gold, because central banks do own a lot of gold. Other than UK, of course, because the Chancellor of the Exchequer, Gordon Brown, sold half of the UK's gold here in 1999. Other than the UK and Canada as well, they don't like to hold gold, some other central banks, but central banks roughly hold about 1.1 billion ounces of gold over the 6.3 billion ounces of gold ever mined. So roughly 1/6 of the total gold stock in the world is held in central bank vaults. So it is true that they do control a lot of what happens, and they certainly have, if you look at historical agreements like Bretton Woods and what FDR did and all the rest. Not a topic of this video, but just to say, can the gold price be suppressed or manipulated in the short term? I think maybe, but I'm quoting a seasoned silver bug. He likes gold as well. His name is David Morgan. David Morgan, he likes to say that can the central banks or can the market even manipulate or suppress the price of gold in the short term? Perhaps. But can they do it in the long term? Well, looking at this chart, I think the evidence is clear that they can't. They can't. Now, gold bugs might want the price to go higher, quicker, faster, but that's up for the market to decide. Over the long term, I think it's hard to argue that the price of gold is suppressed. So over the short term, maybe. Over the long term, no. And one last point here. We've talked about compound growth in prior videos. If you've ever wondered what is the overall all-time compound growth, which follows an exponential curve, so it's the exact same thing here, from the gold price being roughly $1,800 an ounce here in December 2022, all the way back to when it came off of Bretton Woods and the Nixon shock here in 1971 was $40 per ounce. So $40 an ounce here, $1,800 an ounce here, 52-year roughly history. What is the compound annual growth rate of that gold price? It's about 7.7%. That's it for today. Thanks for watching.